To me, this is very similar and eerily reminiscent of the end of 2018 and beginning of 2019. And if you guys remember, at the end of 2018, October, November, December, the markets just fell. And part of it was Powell's going to raise rates, inflation's getting out of control, et cetera, et cetera. And then we got all this data that said China may be entering a real period of malaise, and Powell capitulated, again, trying to stick the landing. And long story short, he didn't. That was a head fake, and the markets just ripped higher.
Hey guys, welcome back to Library of Wealth. Today we have Chamath on the All In podcast, discussing his views on the state of the market and what investors need to watch for in the coming months. Chamath talks about the recent speech by Federal Reserve Chairman Jerome Powell, making a surprising shift from a hawkish stance on interest rates to signaling only 2 more 25 basis point hikes ahead. Chamath sees this as Powell's yielding to market perception, which is leading to a surge in buying activity. He says that this trend is similar to the end of 2018 and the beginning of 2019, where the markets bottomed months before a change became evident. Let's check out the latest interview with Chamath. Before we dive in, don't forget to hit the like button and subscribe to the channel if you enjoy the content we do here. Let's get right into the video.
I watched Powell's speech, and it was really amazing because in December, he was extremely hawkish. And he was basically like, listen, we're going to keep rates higher than you like and longer than you want. And that was pretty clear, and the markets reacted. And then not but 35, 40 days later, he essentially said we have 2 25 basis point hikes left to go. And he's going to try to stick the landing, essentially. And even though the rest of the language in his entire speech and the press conference, if you read it in the absence of his body language, so if you just read the transcript, would seem very hawkish as well. But the reality was he basically capitulated. And then the market essentially said, okay, we're at the end of this thing. And we've talked about this before, but markets tend to bottom 6 to 9 months before it's clear that you could have done this. And so we're a little bit off to the races in the short term. It's compounded by a couple of other factors. One is that at the end of last year, so many people were tax loss harvesting, which means if you had some gains somewhere else, you sold some things that were losing money so that you could net the two together. You saw a lot of stocks. Tesla was probably the poster child for this, trade all the way down to like $108 a share, and it's effectively doubled in the last 30 days, right? So everybody tax loss harvested, everybody degrossed, nobody was really owning anything. And then when Powell basically said we're mostly done, there's been so much systematic buying right now that nobody's really well positioned. The problem is if the stock market keeps going up and all of a sudden we have less restrictive monetary conditions, then we're going to be back at the same place we were before, which is money sloshing around into all kinds of risky assets or more money. You know, there's still an enormous amount of money sitting on the sidelines that has to come into the market now if this thing keeps going higher. So we're in a delicate moment. And if we reignite inflation because all of a sudden more companies have more liquidity that they can tap, right? More money they can raise, more money as a result that they can spend, because we don't have this first inflationary cycle under control, there could be a risk that we reignite inflation. And so then they have to capitulate, the Fed has to capitulate again and start another hiking cycle. So I think it's a complicated moment. I think all of the smart money in Wall Street that I talked to up until this point, they forecasted like this period would be choppy and the second half of the year would be really robust and like you needed to be super long and things were going to be incredible. And when I talked to them this week, they're like, oh God, we weren't positioned for this. We had no risk going into this. We're going to be forced buyers. There's a bunch of companies that are whispering that they want to go public now.
Oh,
and
really?
So the big banks have been calling around trying to book build quietly for some IPOs. And so if they try to kind of crack this capital markets open, I think there's, again, the marginal risk will be that we do whipsaw, as Zach says.
When you say book build, you mean trying to see if you'll get some early takers to buy equity in an IPO, perhaps even in a company like Stripe that's been sitting on the sideline?
So not Stripe, they're in a complicated moment. But when they call it to book build, they basically say, hey, listen, XYZ company, quiet filed, look at the S1, what do you think? Where's the price? Blah, blah, blah. And they're trying to get an indication of whether you'd want to be in the IPO book. So I think that there's a lot of those testing the waters that are now starting again.
Chamath goes on to discuss the current market conditions and the potential risk posed by its escalating valuations. He acknowledges the fragility of the market and warns of reigniting inflation if growth persists, particularly with a rapid increase in tech stocks. He also shares his insights on the expectations of Wall Street's smart money and their lack of readiness for the current market trends. Chamath recognizes the market's hesitance, which is only adding to the uncertainty we're seeing from investors.
The thing that we have to think about is like, most of the market are not people, right? Most of the market are computers and algorithms and ETFs. It's an extremely formulaic buying model. You have components of an index, those represent certain percentages. You have to own those percentages to be relevant as that index. And so it's this reinforced buying loop as well as a reinforced selling loop, right? So when things start moving, those folks have to just systematically move money in. All the humans know that. So the humans tend to front run all the computers, and they basically are the ones that sell into these guys. And then that's what inflates these prices. And similarly, on the way down, humans try to front run it by being short into that stuff. So we could see the capital markets open. Even if we don't, it's actually the worst scenario because now you have all this money going into a fewer number of names. That sort of explains Facebook has doubled in 30, 60 days.
Yeah, I was about to get to that. Yeah.
Tesla has doubled in 30, 60 days. A lot of the tech stocks, like high beta stocks that we are all, helping to build, those companies have just absolutely ripped 60 to 100%. These are not healthy and normal moves. And so the question is, what happens if inflation somehow all of a sudden pokes itself back up? We did a little analysis over here, and it was just basically looking back 60 years of company formation. We looked at all of the 100 most valuable public company startups, and we indexed that to the 10-year interest rate.
So what are we looking at here, Chamath, with this chart?
So basically, we went back from 1960 onwards. So basically, 63 years. And what this shows you is the 100 most valuable public technology companies. Then the size of the circle here is their market cap. And then it's overlaid on top of the 10-year interest rate, as well as gray bars for recessions. So what is this graphic meant to illustrate? Well, it just was for us to study, is there a correlation between the value of companies and what the interest rates were or what the economy was doing at the time? And to your point, Jason, the trend is pretty starkly made on this chart, which is that if you are a company that was founded in a period of austerity, you had the ability in general to build a much larger company than that which was founded in a period of wealth and excess.
Chamath sheds light on the shift in the stock market's dynamics, with algorithms and computers playing a dominant role in driving market movements rather than humans. He explains the nature of buying and selling stocks and how humans tend to anticipate the actions of computers, leading to inflated stock prices. He presents his findings from analyzing the 100 most valuable public company startups over the past 60 years, indexed to the 10-year interest rate. The results show that companies founded during the austerity tend to become bigger compared to those established during periods of wealth and excess. Chamath highlights the tremendous potential for growth when technology experiences significant changes like we're seeing now. What do you think about Chamath's take on the economy so far in 2023 and the potential problems in the market we're seeing start to form? Comment down below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.